Ray Dalio appears in economic dramas every time. How does the manager of the biggest hedge fund in the world handle investing when he cautious that cash is worthless and that it is impossible to time the market? For today's video, we will be going to talk about Ray Dalio's last warning. Prepare for the worst. Let's get started. Latest warning. Interview. If that's the right verb, the stock market has been correcting itself over the past few weeks, and many of the mistakes sprang from the alleged bubble, such as whether it is now better to purchase than sell everything because the markets are declining. Dalio reply, okay, everyone now has money and it's quite simple to borrow money to make purchases since they created a lot of debt and distributed a lot of money. Therefore, if you create far more purchasing power than you do products and services, you will experience much greater inflation. Moreover, the Federal Reserve has lagged behind the tightening monetary policy, and as a result, interest rates are beginning to climb in order to deal with that. As a result, all resources are in competition with one another. If bond yields have increased by 1%, then the cost of that free money will stand below. But it will be a little bit more expensive. With that information, you can change everything to reflect the present value of future cash flows. Nonetheless, it signifies that the interest rate will increase by 1%. That means that all other assets must change, and we are currently making that kind of adjustment. It refers to the previous easy times when you were given free money. There was less inflation and you didn't have a lot of time. These have been completed. We are currently in a different phase of the cycle. Interview. How would market be impacted by a US response to a Russian invasion of Ukraine? Dalio reply. Investors are starting to wonder what a war market economy might be like. How do markets fare during conflicts, since they are not accustomed to conflicts? Okay, it won't be a major conflict in my opinion, but I have no idea about such stuff. But it's useful to understand how various forms of payment operate there. Therefore, I believe those kinds of things will receive greater attention. SPDR S&P 500 ETF SPY. You may be familiar with the SPY versus SPY. The Dalio introduces us the SPY versus cash in his portfolio. Over $894 million are hidden in the lead holding, with just over 1.9 million shares of equities, or slightly more than 5% of the portfolio. There are no major secrets preserved, despite the SPY tag. The exchange-traded fund SPDR S&P 500 ETF SPY was created, ETF that follows the S&P 500 Standard and Poor's Index, by maintaining a portfolio of equities and businesses that are represented in the S&P 500. It achieves this. It is a favorite among ETF supporters and is included in the renowned Berkshire Hathaway portfolio. SPY creates chances for simple liquidity. The issue presents an intriguing catch-22. Over time, Dalio had been reducing the amount of the stock he owned. He reduced his size once again, but he changed his portfolio so subsequently that the holding is now number one as a result. The sales most likely reflect the aforementioned market pessimism in light of Dalio's observation of stock bubbles and the general state of the economy. Many people believe that the S&P 500 is most accurate market indicator, considering that unlike the more famous Dow Jones Industrial Average, which only contains 30 stocks, it offers a more comprehensive view. The S&P 500 has a long and illustrious history dating back 65 years in March. Having said that, new times are here. Dalio believes it is difficult to predict the future or time of this market, considering the particular confluence of consequences of contemporary problems. In the end, it's hard to predict where the crazy trip will lead. If nothing else, cases are decreasing more steadily, which should help the hunt for economic normalcy. On the other hand, discontent grows among anxious consumers who are unclear if they can buy necessities, let alone have the ability to spend the extra money that many firms depend on. Whatever the case, his investment ought to remain steady over time. A 10% yearly return has historically been the average for the S&P 500. As of this writing, the S&P 500 is down more than 6% year to date, so the outcomes are currently moving in the opposite direction. Procter & Gamble, PG. You have a device with this video and many Procter & Gamble items on your shelves. Old Spice, Crest, Head & Shoulders, Downy, and Gillette are just a few of the many well-known products that fall within the Procter & Gamble category. The large consumer Caesar also reduces the Bridgewater portfolio by around 5%. The Vanguard FTSE Emerging Markets ETF, VWO. In the previous 13F, Water's largest holding is now the endearing third. Over 25 million accounts holders are served by Vanguard, and Dalio is definitely among the major investors. Over $831 million of the Bridgewater portfolio are invested in the Vanguard's FTSE Emerging Markets ETF, a long name for a business with a long record of reputable customers who are happy with its highly valued services. Vanguard continues to be one of the most prestigious names in investing. Vanguard opens a variety of investment solutions, including IRAs, ETFs, 401k plans, and mutual funds that routinely outperform the market. In the next 90 seconds, you will learn what an ETF is, if you don't already. An ETF is a type of investment that invests in securities like mutual funds, equities, and bonds. Investors purchase fund shares, but they do not acquire ownership of the underlying assets. Shares of ETFs are exchanged on a stock market. ETFs have the benefit of having less volatility than other types of investment throughout trading hours, and the freedom to purchase and sell at any time. Trading is not free, even though people are free to do it. The biggest disadvantage of investing in ETFs is having to pay commissions on each trade. PepsiCo, PEP. The taste of victory is discernible in Pepsi to Dalio's sophisticated profitability palette. Guzzles make up less than 3% of the Bridgewater portfolio, over 3 million shares at a market value of roughly $530 million. The value of the top three assets is extremely close to one another, which is an intriguing observation about those data. However, this holding leaves a tiny gap. And what is going to Pepsi? More than merely producing pop. Did you realize that PepsiCo owns Lay's and Doritos? Now you do. Mentioning adding chips during the most recent quarter, PepsiCo made a marketing wager. Prior to the previous Super Bowl, PepsiCo increased promotion in the quarter surrounding the National Football League. Both businesses have been updating their product lines to reflect shifting customer preferences. The sale of PepsiCo's Tropicana Juice division, which has been recording slower sales than other divisions, was just finalized. Like other producers and makers of consumer goods, the price of inputs such as the sugar in their drinks has increased for two soda competitors, the price of delivering their goods internationally, and the amount of aluminum used to make cans. Inflation in the US increased to 7.5% annually in January. The Labor Department earlier this month jumping to a 4-decade high to assist in offset supply chain and input issues. PepsiCo raised prices, organic revenue, which is directly produced from within the company and not outside endeavors, or acquisitions, rose 11.9%, aided by a 7% increase in prices. Johnson & Johnson, J&J. First place, Johnson & Johnson completes the list. The stock is worth somewhat more than 3 million shares, which is about equivalent to PepsiCo. The renowned corporation is currently under criticism because of hot messes. Johnson & Johnson restarted its rocky path to vaccine viability by stopping the single-dose vaccines manufacture more than a week ago. You probably think of Charlie Munger, who is Warren Buffett's right-hand man, when you think of super investors and Costco. Since 1997, he has served as a director of Costco. Nearly 916,000 shares of Costco, worth at roughly $520 million, are now owned by Dalio. Over the years, Costco has built up an admirable reputation as a tenacious business with traditional roots, solid financial performance, and solid moral standing with both employees and customers. The financial smiles while nodding their heads. The Costco Wholesale Company cost posted a first quarter YOY growth rate of nearly 17%, which is great. Most benefited from robust post-pandemic consumer demand. Costco reported $50.36 billion in sales and $1.32 billion in net income for the same time period, demonstrating remarkable growth rates of 16.5% and 12.8% respectively. Coca-Cola. Coke carefully tracks Pepsi's moves, about 8.7 million shares, which are worth about $514 million, are included in Dalio's portfolio. Coke's operating strategies are similar to Pepsi's. In China, Coke, a sponsor of Olympics, has been promoting the games not in the US or other markets though, similar to how Pepsi reached its agreement with Tropicana. In November, Coke reached a $5.6 billion agreement to fully manage Body Armor, a sports drink that has been outpacing the Coke soda industry in terms of sales growth. Pepsi experienced the same supply chain issues and escalating production cost issues. Operating income at Coke decreased by approximately 30%. Although Coke reported that the fourth quarter of 2021 was the first quarter since the pandemic started, there is a silver lining, stated the number of its sales in restaurants and other eat-in establishments exceeds expectations from 2019. More folks are going out and the market resumes. Alibaba. Some wouldn't touch Alibaba with a 10-foot pole or 10-figure account. Others lean on foresight to bank on Alibaba's entailment, with the Chinese government generating a buy low opportunity that would pay handsomely if the smoke clears. And Alibaba catches financial fire en route to rocketing to its sky-high ceiling for a longer period of time than nearly any other major investor. Dalio has supported China with a position of over $507 million and about 4.3 million shares. Bridgewater is putting its money where its mouth is. The move might entice some of you to follow in his gold-paved footsteps, a caution anyone to do their own due diligence before diving into the deep end of uncertain waters, particularly when bureaucratic sharks with a vested nationality-motivated interest are swimming in it. iShare Core MSCI Emerging Markets ETF. This holding improved from being Bridgewater's 10th largest holding earlier in the year to third place. 8.3 million shares, or more than $496 million, are needed to purchase 2.89% of the portfolio. Personally, we wouldn't put money into the holding. Watch on and I'll explain why. These wild times haven't been the best for emerging markets investing options, as the name suggests mainly relies on growth stocks. Growth stocks expect the majority of their cash flow to be earned in the future. When inflation rates rise, the expectations fall and future cash flows decrease in value. We are the highest point of inflation since 1982. The iShares Core MSCI Emerging Markets ETF is the younger, cheaper variation on the BlackRock's flagship's iShares MSCI Emerging Markets ETF. IEMG made its debut in 2012 as a new, incredibly affordable iShare Score series. This was made to draw investors who would buy and hold. This is unquestionably a break from healthy visible equities that invest in established businesses or institutions with strong track records that can withstand turbulent economic times. McDonald's, MCD. Dalio is loving McDonald's stock. We don't know how many Happy Meals Dalio bought in his life. The stock pleases him enough to buy almost 1.7 million shares, valued at almost $450 million. You could buy way over 112 million Big Macs with that amount. Bridgewater took a big leap with this stock as it's the second biggest share percentage increase among the top 10 holdings. Even Ronald McDonald could see why. Consumers covet McDonald's food and eat there, whether their arteries want them to or not. The Golden Arc overlooks the golden opportunity in a mix of rising cost and people feeling more confident to go out of their homes and order McDonald's with regularity again as cases continue to dwindle. Pessimists dispute the first claim by arguing that fast food is an elastic good and that there is a glut of competition in the food industry. Additionally, worries that people will travel less as a result of the unsettling trend in petrol prices. I would counter that McDonald's brand loyalty is easily accessible, and because its meals gives millions of individuals such a high dopamine surge, it is able to block off current events more effectively than possibly just about any other service on the planet. What did our topic educate you on? Please share your thoughts in the space provided below. Please click the notification bell, give this video a thumbs up, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you